Welcome back to Squawk Box. Let's get back to our special guest, David Tepper. He's the founder, president, and CIO of $16 billion hedge fund, Appaloosa Management. And when we last left you before the commercial, we were all trying to get a read of where you were going with this in terms of the equity market. I think you were suggesting that it's cheaply priced, but you can tell me.
You think?
That's where I thought you were going. That was. I thought that
you are a keen analyst. I got to tell you, you're a really keen analyst.
You were waffling. You were going back.
I was waffling.
You were giving some other signals.
I was giving signals.
Well, look. The bond market was too high.
Listen, at 12 times next year's with these interest rates, with this Fed, yeah, of course it's cheap. But you still do have the stuff that's going on in Washington that's holding back everybody and everything. The question is, how much does it mean and what will it do when you're holding back people from the end of the year? Because if it does blow up, the market will probably go down 2 or 3%. Okay? That's what's going to happen.
So 3% is your downside right now.
Could it be 5%? Sure. If there's other things that can happen. But I think there's very limited downside. I think the market.
How much room to run on the upside?
A lot. Listen, you had Fisher on here on Friday. Fisher basically told you that. I mean, when I listened to Fisher, I don't know if you guys were listening to him. You talk, but I wonder if you listened to it. I'm sorry. I'm sorry. I'm sorry.
This is a tough morning.
It is a tough morning. You know what? I'm sorry. I apologize. But, Fisher, when he was on there, what I kind of viewed when he was talking about is how good the economy is, how good it can be. When he was talking, I got the sense from listening to him that he's nervous that so much money coming in will push us up beyond where we should be in growth, beyond where we should be, push us faster than inflation limit, although we have no inflation. And we're unlikely to have inflation at the capacity utilization we're at and the unemployment rate we're at. But he had that nervousness. And listen,
It sounded like that before, though. He's always been a little more hawkish.
But he sounded like a hawkish on there, but a real bull on the economy. Right. Okay, a real bull. And every guy you have that's there, will talk about the economy, will say how good it can be. And, I don't know, people don't want to believe it, but it can be really good. And listen, you hope that these guys cannot mess it up. They can really. Washington. I mean, what should happen, and why I say it's 3%, and I really think there's no downside in some fashion, because I think what they're going to do is they're going to do the Plan B, the Senate bill, and the Senate bill looks like they have to do that. If I was Republicans and they don't do the Senate bill, they're committing suicide. And I have to tell you one thing about politicians, they like to get elected. Right. So I think they're going to do that. On the other hand, you have a guy that's not up for election that really should be making suggestions and getting things done. Okay? You know who that guy is?
The president.
I think you're indicating the president.
The president of the United States of America, yes. He's the guy. Everybody knows certain things have to get done. Listen, taxes are going to go up in some fashion or another. Everybody knows it. Everybody knows. My grandmother and my grandfathers all lived to 72, 73. Okay? My parents, my dad is dead now, but, he lived into his 80s. My mother's 80, and she's going to live a long time. I'm sure of this. Right. Okay? But, that's 10 more years. I mean, you had this, I guess Medicare was 65 was passed, something like that. This is common sense stuff. Take the age up to 67. Come on. This is common sense. I don't want to hear about coal miners. Make the coal industry pay for it, or one industry that somebody will talk to. Or exclude them from the general legislation.
That's what Simpson Bowles does. It will take people who do backbreaking work
and so easy. And the president has to put this forward because people are afraid to say the words to put it forward because they were afraid of getting elected again. It is so easy. So hopefully the president of the United States does what's easy and does what's right and does try to fix his long-term problem. Because, look, here's the way the numbers work out. And you guys know this, and everybody knows this. If you do the Senate bill, you have no problem for 10 years. You really have no problem. Your debt to GDP is not going up for 10 years. It's just not. You can do the numbers. It's not going up for 10 years. But after 10 years, when Joe is, retiring and other people are starting to retire, you have a real problem. You start escalating problem. We should really make a down payment on that problem now. And if this president wants to have a legacy, if he truly wants to have a legacy, he should attack this problem. He should bang heads. Did you guys see that Lincoln movie?
Yep.
I haven't seen it yet.
You see the Lincoln movie? You saw it?
Yep.
You know what I'm talking about. You get it done. He should get it done with the Democrats. Get it done. Now,
if you see the Hobbit, can I ask you something? Do you remember when the first time you made what we keep talking about, your first appearance here, when you talked about
the Tepper call?
Yeah, either the economy will improve or the Fed will act. In hindsight, I think I saw the markets react to what the Fed did. did the economy actually react to all that Fed stimulus?
Absolutely.
So we would have. Is it a counterfactual, or it did get better? It didn't get worse.
Look,
it's pretty good.
Look, you know what I hear? You know, it's amazing how many people said the money didn't matter. The Fed didn't matter. They shouldn't have done this. They shouldn't have done it to begin with. The fact of the matter is, you have incredible. We're just talking about the credit markets. Okay, I can tell you what the credit markets were then. Okay, Ivory Coast was 9. I can tell you what different things were then.
Yeah.
These credit markets are anything but robust. They are robust. They are absolutely robust right now. And not just the credit markets in the marketplace. In auto loans, you're now seeing subprime, sensible subprime.
Right.
Okay? Because you should do some subprime in auto loans. Okay?
Right.
Sensible. Okay? That is getting done, and that's why you're seeing
There's been deleverage. There's been a lot of good things. But the economy itself.
But that is the economy,
It's been
Joe.
sub 2%.
But that,
right?
yeah, but you still have other things that can happen. And now the thing holding back the economy, I do believe the economy is going to grow faster if we can get through this
So it is
logjam.
Washington. Okay, so
I think now it's Washington.
You add the $1 trillion of stimulus to what we're getting, something positive out of Washington. Then it's not just the stock market that reacts. You actually will see 2.5, 3, 3.5.
Yeah, and
see some GDP growth.
It hasn't been the stock market that's just react. You do have a healing. People are getting auto loans.
Right. But you don't
do
think
have
of the
a housing
economy
pickup.
being, you know,
it is
8%
economy.
unemployment.
But stocks have come up a long way since you made that initial
Will we
model.
get down to 6.5?
The question about stocks is how much have they've come up, but they haven't come up that much in a PE. And remember, what was that, 2010?
Right.
Okay, we're going into 2013.
Right.
Okay, so we have had years. So, this is not crazy.
So we'll get
No,
back.
no, it's not, but I'm asking, is it as cheap relative to what we were looking at back then?
It is
still the same?
really, really interesting, and I hate to say how cheap it is because of the money, and we could talk about it if you have another
We're
break.
going to. Yeah, as soon as unless
come
you're
back and do
buying all
more.
the, which you could.
We've got much more from David Tepper still ahead.